Hey guys, Adam Rose, Vice President and Senior Loan Officer of Western Ohio Mortgage here in Sydney, Ohio. Today is another episode of the Mortgage Guy podcast, and today is an update from national advocacy from the mortgage or by the Mortgage Bankers Association that we just held in Washington, D.C. this past week. Kind of give you some updates on what happened, what was the point, good information, some bad information. So we'll kind of just see and kind of sort through it a little bit. There's going to be a lot more than what I'm going to cover here. I'm going to give you kind of a broad brushstroke on what it was, what we were doing there, some of the things that we were pushing, and maybe a little bit of bad news. So let's just go ahead and rip the Band-Aid on the bad news side. So Mike Frantantoni, our chief economist for the Mortgage Bankers Association, didn't have a lot of good news. With the ongoing conflicts going on in Iran, I mean, everybody's seeing it right now. Whether you feel we should or should not be there, nonetheless, we are there. The impacts on the oil futures spiking is what's caused, obviously, the most pain in the U.S. Outside of the actual military action themselves, just from an economic standpoint. And due to that, the concern is, and his thoughts, is we may be going a little bit back up on the inflation piece. Now, remember, inflation numbers are used over a 12-month look back based off the CPI, which is a consumer price index. So you're taking the rolling 12 in mind, and with what's going on currently, the anticipation is that we could be peaking back into the upper threes, possibly hit 4 before everything calms down. So the sooner this does end peacefully, the better off everything will be in the market. But hey, you got to do what you got to do. It's got to be finished to the end to make sure the terms are in our favor as much as possible. So hopefully it does end sooner rather than later, and we can move on and hopefully not have as bad news as what this is going to show. So with that in mind, on the inflationary numbers, since, like I said, 12-month rolling average, the likelihood that we will see any kind of rate cuts this year from the Fed went from semi-confident to 0. The anticipation is there will be no Fed rate cut now. Originally, at the beginning of the year, they were thinking 2 to 3. I don't think it's going to happen anymore. We will still see some volatility in the market. We will still see bouncing rates between 6 and 7. It's going to happen. It is nothing that our market is not already familiar with or used to, for that matter. They've been experiencing these rates for the last 2.5, 3 years. So it's just going to be a little bit more of the same, unfortunately. Now, I don't want that to hinder you from purchasing, of course. Spring market is here. Contracts are flying. Houses are flying off the market. People are still purchasing. And I do believe it's just because, waiting around for so many years for rates to decrease when they've just kind of stayed stagnant, people are kind of over that. So they're in the market. It is happening. I don't personally see it getting a lot worse than where we're currently at. Again, we're going to see that 6 to 7 range constantly. I just locked a rate the other day. All right. Again, I don't like to disclose APR, so I'm not even going to talk. I shouldn't even mention it. But anyways, it was a conventional deal. We got 6 1/8 on it on a home ready program. APR was 6.32. Solid credit, 3% down. So I mean, rates are still okay, right? But you're going to see some of these higher price borrowers with the loan level pricing adjustments, of which I've mentioned thousands of times before. You're still seeing that 6.49 range-ish, 6.5. That's going to be very normal. If you hear a lender say 6.5, for example, they're not bad, right? They're in the market. So just a heads up there. But anyways, let's go to national advocacy. So day one, so I got it in there on Sunday. Day one is mainly just state stuff. I'm the president of the Ohio Mortgage Bankers Association, so we talked about some strategies on membership and value adds and things of that nature, and make sure we are operating best so we can operate. We're high efficiency. So that was good. Some pretty good details there. And then day two, we have a lot of congressmen and senators come in. They come and talk to us about housing-related issues. We get to do some roundtable stuff, talk about what, our opinions, what's MBA's position on certain issues, specifically speaking, the road to legislation, which is a big bill that passed both House and Senate. But there's a couple of stop points in there, and it might go to conference basically to discuss out and iron out some of the details. But it's the biggest piece of housing legislation that's been going through the Congress in I don't even know how long at this point, very long time. So they really need to make a move on it. But there were some positions there that were negative in regards to impacting the market. I mean, one of the big sticking points for a lot of people was the investor-related items with taking out institutional investors out of single family. I'm not going to argue for them because I believe it should come out. But there was a piece in there that was impacting the build-to-rent concept that some people do. That's what one of the sticking points was, because that was attached to that piece. People should be able to build to rent. That's just, not everybody can purchase a home. Not everybody wants to purchase a home. So if we remove the ability to build to rent, that's going to be a big problem. So that's kind of what slowed that piece up a little bit. We also discussed increasing the FHA loan limits for multifamily new construction. Now, again, everybody thinks FHA. When we talk FHA, we're talking about residential homes, right? 1 to 4 unit. We're talking commercial stuff, okay? HUD does invest and offer financing for commercial development. That is accurate, right? That does happen. Large institutional companies and developers can access this through the 232. I think it's the 232 program. I may be off on that, so no lender trolls out there hit me on that one. All right. But anyways, increasing those loan limits. There were no loan limit increases since 2003, which is insane. I mean, look at the cost to construct a home today, or especially multifamily or commercial or apartment complexes. I can only imagine the cost difference in the last 23 years. There's never been an increase and during that time frame, and some of the verbiage that's in there now might, by accident, unintentionally decrease that loan limit. So that was something that we were pushing to make sure they review in conference. And then there was a couple of disclosures coming out that was absolutely no assistance to the consumer. I get the good intent behind it, but it made zero sense to do it. The benefit was to try to see if we can reveal more VA-eligible borrowers, but where they had this at in the process, all this is going to do is add cost expenses to the disclosure process and the origination costs, and it made no sense, right? Because the way we interview clients and people when they're buying a home, part of the questioning in line is, hey, have you ever served in the military? So we find out up front. Sticking a bunch of extra disclosures in there to see if they are a veteran is a big lift for lenders, and we were kind of pushing back against that. But that's one of the big things. I also was pushing my own agenda. So Teresa Rose, our owner, and I have a proposal to change how FHA is structured, and it's going to be for the good, right? The biggest benefit, I mean, honestly, it's double-edged. It's going to assist in decreasing the expense of originating FHA loans. It's going to decrease the average house payment for consumers on FHA loans. It's going to decrease their out-of-pocket expense. And if done correctly, based off our proposal, it's actually going to improve the performance, decrease the amount of potential foreclosures or delinquency rates on FHA financing. It's a win-win for everybody. Win-win for the loan officer and the company. It's a win for the consumer in decreasing their out-of-pocket expenses and the monthly payments. It is a win for FHA to decrease delinquency rates. We are currently in the stages, and the thing is most of the congressmen we got to meet, they were for it, right? They liked the proposal. They liked the concept behind it and the understanding of why. And the ripple effect that it could have. Now they've come back to me and said, time to see the numbers, right? The proof is in the pudding. So that's what we're going to be working on now. It's going to take some time, but that is what your local lender here in Sydney, Ohio is working on. It's changing the way a federal program is going to operate and be offered to the consumer. And it could be massive. So anyways, that's all I got for you guys this week. I hope it was entertaining and informative. There's a lot more details and information that I'll provide in the coming weeks on national advocacy and what's coming down the pike and some of the changes that you might see, including credit reporting costs, which was a big topic at our day on the Hill. So remember to subscribe on YouTube. Check us out on Apple Podcasts and Spotify, and we'll catch you all next week.